Let me begin with an observation that may unsettle you. Most people who remain financially stuck throughout their lives are not defeated by their income. They are not undone by bad luck, by economic downturns, or even by genuine misfortune. They are defeated by a single habit, a habit so quiet, so socially acceptable, so dressed in the language of intelligence and ambition that they never recognize it for what it is. I have spent my career studying markets, studying investors, and most importantly, studying human behavior around money. And I have concluded that there is one silent wealth killer that claims more victims than any recession, any market crash, any period of inflation. That habit is speculation disguised as investing. Let me say it plainly. The person who believes they are investing while they are actually speculating is in a more dangerous position than the person who knows they are gambling. The gambler at least understands the nature of their activity, but the speculator who believes himself an investor, he combines the risks of gambling with the overconfidence of expertise. This is the silent wealth killer because it does not announce itself. It does not feel reckless. It feels smart. It feels modern. It feels like participation in the great engine of capitalism. When everyone around you speaks of opportunities, of explosive growth, of getting in early, of not missing out, speculation feels not only reasonable but necessary. And this is precisely why it is so destructive. In 2026, this habit is more prevalent and more dangerous than at any point I could have imagined. The tools for speculation have never been more accessible. The voices encouraging it have never been louder. The line between investing and gambling has never been more deliberately blurred. But I am not here to frighten you. I am here to offer you something far less exciting and far more valuable. I am here to offer you a boring alternative, a process, a framework that has survived every market condition, every technological revolution, every period of euphoria and despair. The principles I will share with you today are not secrets. They are not complicated. They are simply unfashionable. And that is precisely why they work. To understand why speculation disguised as investing keeps people poor, we must first understand the psychology that drives it. Human beings are not naturally suited to investing. We are wired for action, for certainty, for immediate feedback. Our ancestors survived by responding quickly to threats and opportunities. The brain that kept our forebears alive on the savannah is the same brain that sabotages our financial futures. Consider what speculation offers. It offers excitement. It offers the thrill of being right. It offers the intoxicating feeling of having special knowledge, of seeing what others cannot see. It offers stories to tell, battles to fight, wins to celebrate. It transforms the slow, grinding process of wealth accumulation into a game where every day brings new drama. Investing, true investing, offers none of these things. It offers boredom. It offers patience. It offers the quiet satisfaction of a sound process executed over decades. Which would you rather discuss at a dinner party? This is not a trivial question. Social proof is one of the most powerful forces in human behavior. When your neighbor speaks of doubling his money in weeks, when your coworker shares tips about the next breakthrough, when your social media feed floods with stories of ordinary people becoming wealthy overnight, the pressure to participate becomes almost unbearable. And here is the cruelest part. Occasionally, the speculators win. Occasionally, the tips are correct. Occasionally, someone does double their money in weeks. And these stories are told and retold and amplified until they seem not like exceptions, but like expectations. No one shares the story of the person who followed a tip and lost 40%. No one celebrates the investor who earned 7% annually for 30 years and retired with security and dignity. There is no drama in safety. There is no viral content in patience. This creates a systematic distortion in our perception of what works. We see the winners of speculation. We do not see the vast graveyard of losers. Now, let me address something fundamental. Most people misunderstand risk entirely. Risk is not volatility. Risk is not the daily movement of prices. Risk is not watching your account balance fluctuate. These things may be uncomfortable, but they are not risk. Risk is the probability of permanent loss. Risk is the chance that you will not achieve your financial objectives. Risk is the possibility that you will have less money in the future in real terms than you have today. The speculator and the investor have entirely different relationships with risk. The speculator accepts enormous risk in pursuit of excitement and exceptional returns. The investor accepts modest returns in pursuit of safety and the preservation of capital. The speculator asks, how much can I make? The investor asks, how much can I lose? In 2026, the noise that encourages speculation has reached unprecedented levels. You carry in your pocket a device that delivers constant financial stimulus. Every notification, every headline, every algorithmic recommendation is designed to provoke action, to make you feel that you must do something, must not miss out, must participate in the latest opportunity. The platforms that deliver this content are not designed to make you wealthy. They are designed to capture your attention, and nothing captures attention like the promise of quick riches and the fear of being left behind. This is the environment in which the silent wealth killer thrives. It feeds on anxiety. It feeds on impatience. It feeds on the entirely human desire to solve your problems quickly rather than slowly. And so people remain broke, not because they earn too little, not because they face unusual hardships, but because they confuse activity with progress, excitement with wisdom, and speculation with investing. Let me now draw a line that most people cross without realizing it. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. This definition has three components, and each is essential. First, thorough analysis. This means you have studied what you are buying. You understand the business or the asset. You can explain in simple terms how it makes money and why it is likely to continue doing so. You have examined the financial statements, the competitive position, the quality of management. You have done work that most people are unwilling to do. Second, safety of principal. This means your primary concern is not losing money. Before you ask how much you might gain, you have determined how much you might lose and whether you can accept that possibility. You have established that even if things go worse than expected, your capital is reasonably protected. Third, adequate return, not maximum return, not exceptional return, adequate return, a return that compensates you fairly for the use of your capital and the assumption of reasonable risk. The investor does not swing for the fences. The investor aims for consistent base hits over a long career. Any operation that fails to meet these three criteria is speculation. It may be intelligent speculation, it may be successful speculation, but it is not investing. Now let me give you examples of speculation disguised as investing. Consider the person who buys a stock because its price has risen sharply. They see a chart moving upward and conclude that this movement will continue. This is not analysis. This is pattern recognition applied to random movement. The past direction of a price tells you nothing certain about its future direction. Yet millions of people make decisions this way every day and believe they are investing. Consider the person who buys because everyone is talking about something. A new technology, a new company, a new asset class that promises to revolutionize everything. The excitement is palpable. The stories are compelling. The fear of missing out is overwhelming. But excitement is not analysis. Popularity is not safety. And the fact that everyone believes something will happen does not make it more likely to happen. Often, it makes it less likely because the belief has already been reflected in the price. Consider the person who buys without a margin of safety. They have calculated that a stock is worth $50 and they pay $49.50. They have no protection against being wrong. They have no cushion against unexpected developments. They have assumed that their analysis is perfect, and analysis is never perfect. Each of these people believes they are investing. Each of these people will tell you they have done their research. Each of these people is speculating. Here is the fundamental distinction. Prediction is not analysis. Analysis asks, what is this worth today based on facts I can verify? Prediction asks, what will this be worth tomorrow based on things I cannot know? The investor stays within the realm of analysis. The speculator ventures into the realm of prediction, and the realm of prediction is crowded with highly intelligent, highly educated, highly motivated people who are wrong more often than they are right. If professional forecasters with vast resources cannot consistently predict markets, what chance does the individual with a smartphone and a few hours of spare time have? The honest answer is very little. This is not pessimism. This is realism. And realism is the foundation of intelligent investing. Now let us turn to the cure. If speculation disguised as investing is the disease, what is the remedy? The remedy is a set of principles that are simple to understand and difficult to follow. They are difficult not because they are complex, but because they require you to act against your instincts. They require you to be bored when others are excited, to be patient when others are active, to be humble when others are confident. Let me walk through these principles one by one. Asterisk, asterisk A. Margin of safety, asterisk, asterisk. This is the central concept of intelligent investing, and I will explain it with a simple metaphor. Imagine you are buying a used car. The seller tells you the car is worth $10,000. You inspect the car carefully. You check the mileage, the maintenance records, the condition of the engine. You conclude that, yes, the car appears to be worth approximately $10,000. Do you pay $10,000? You do not. You offer $8,000, perhaps $7,500. You build in a margin for the things you cannot see, the problems that will only reveal themselves after you drive away, the repairs that will be needed sooner than expected. This is margin of safety, the acknowledgement that you might be wrong, the protection against your own fallibility. In investing, margin of safety means paying substantially less than your conservative estimate of intrinsic value. If you calculate that a business is worth $100 per share, you do not pay $95. You wait until you can pay $70 or $60. The larger the margin, the greater your protection against error and misfortune. Most people understand this concept when buying a house or a car. They forget it entirely when buying stocks. They pay whatever the market demands because they assume the market knows something they do not. The market knows nothing. The market is simply the aggregation of everyone else's opinions, fears, and greed. It deserves respect, but not reverence. Asterisk, asterisk B, capital preservation, asterisk, asterisk. For the ordinary person, the primary investment objective must be the preservation of capital, not growth, not income, preservation. This sounds conservative because it is conservative. But consider the mathematics. If you lose 50% of your capital, you must gain 100% to return to where you started. If you lose 33%, you must gain 50%. The mathematics of loss are merciless. The investor who avoids serious losses will, over time, almost certainly outperform the investor who achieves occasional spectacular gains punctuated by devastating losses. Wealth is not built by winning. Wealth is built by not losing. Asterisk, asterisk C, Mr. Market, asterisk, asterisk. Let me introduce you to a character I find useful for understanding market psychology. Imagine you have a business partner named Mr. Market. Every day, Mr. Market appears at your door and offers to buy your share of the business or sell you his share. But Mr. Market is emotionally unstable. Some days he is euphoric and offers you wildly inflated prices. Other days he is depressed and offers you absurdly low prices. You are under no obligation to transact with Mr. Market. You can ignore him entirely. You can take advantage of his foolishness when he offers you a genuine bargain, but you are never required to accept his valuation of your business. This is the proper relationship with financial markets. They are there to serve you, not to instruct you. When Mr. Market offers you a wonderful business at a depressed price, you buy. When he offers to pay you an absurd price for something you own, you sell. And on the many days when his prices are neither foolish nor wise, you do nothing. Most people reverse this relationship. They accept Mr. Market as an authority. They assume that his prices reflect wisdom rather than mood. They feel compelled to act when he acts. This is a profound error. Asterisk, asterisk D. Temperament over IQ, asterisk, asterisk. Success in investing does not require exceptional intelligence. I have seen brilliant people destroy themselves through speculation, and I have seen people of modest intellect build substantial wealth through discipline. What investing requires is temperament, the ability to remain calm when others panic, the ability to remain skeptical when others are euphoric, the ability to tolerate boredom, the ability to do nothing when doing nothing is the correct action. The greatest enemy of the investor is not the market. It is himself, his impatience, his ego, his need to be right, his fear of looking foolish, his desire for action. If you can master your temperament, your results will take care of themselves. Asterisk, asterisk E. The defensive investor, asterisk, asterisk. For most people, I recommend what I call the defensive approach. This is not an insult. It is a recognition that most people have neither the time, the inclination, nor the emotional constitution to engage actively with individual securities. The defensive investor builds a portfolio that requires minimal maintenance and provides adequate protection against serious error. This means broad diversification. It means low cost. It means simple, understandable holdings. It means predetermined rules that remove the need for constant judgment. The defensive investor might hold a diversified portfolio of quality bonds and broad stock market indices, rebalanced occasionally to maintain their target allocation. They contribute regularly regardless of market conditions. They ignore headlines. They ignore tips. They ignore predictions. This approach will not make you rich quickly. It will, over decades, make you financially secure with high probability. Asterisk, asterisk, F. The enterprising investor, asterisk, asterisk. There is another path for those with the time, knowledge, and temperament to pursue it. The enterprising investor actively searches for undervalued securities and is willing to devote significant effort to analysis. But let me be clear. The enterprising approach is not for most people. It requires substantial work. It requires strict discipline. It requires the ability to be wrong repeatedly and continue without losing confidence or becoming reckless. The enterprising investor must have clear criteria for selection and the discipline to adhere to them. They must be patient enough to wait months or years for opportunities. They must be independent enough to buy when everyone is selling and sell when everyone is buying. If you cannot commit to this fully, you should not attempt it at all. A half-hearted, enterprising approach is worse than a fully committed defensive approach. Asterisk, asterisk, G. Warnings. Asterisk, asterisk. Let me conclude this section with explicit warnings. Avoid leverage until you have many years of experience and substantial capital you can afford to lose. Borrowing money to invest transforms volatility into potential ruin. Ignore tips entirely. If someone tells you about a wonderful opportunity, ask yourself why they are sharing it with you rather than exploiting it silently themselves. The answer is usually that they are either selling something or seeking validation for a decision they have already made. Do not attempt to time the market. I have never known anyone who could consistently predict when markets would rise or fall. I have known many people who destroyed themselves trying. Be suspicious of narratives that are not supported by numbers. A compelling story about the future is not analysis, it is entertainment. Let me now translate these principles into a practical system for someone beginning today. First, stop the bleeding. Before you invest a single dollar, you must understand where your money goes. Most people have no idea. They earn income, they spend income, and the difference, if there is a difference, is often smaller than they imagine. You must identify your spending leaks, the subscriptions you forgot you had, the lifestyle inflation that accompanied your last raise, the small purchases that accumulate into large sums. You cannot build wealth while it drains away unnoticed. This is not about deprivation. This is about awareness. You cannot manage what you do not measure. Second, build a cash buffer. Before you invest, you need what people commonly call an emergency fund. I prefer to think of it as a stability fund. Its purpose is to ensure that short-term financial disruptions do not force you to liquidate long-term investments at unfavorable times. 3 to 6 months of essential expenses is a reasonable target for most people. Hold this in something boring and accessible, a savings account, treasury bills, something that will be there when you need it without drama. This buffer is not an investment. It is insurance. It is the foundation upon which your investment program is built. Third, automate your saving and investing. Willpower is a limited resource. If you rely on willpower to save and invest, you will fail eventually. The month will be stressful, the expense will be unexpected, the temptation will be irresistible. Instead, remove the decision from your hands. Arrange for money to move automatically from your income to your investment accounts before you have the opportunity to spend it. Treat this transfer as you treat a bill, non-negotiable, invisible, automatic. The power of this approach is not mathematical. It is psychological. What you do not see, you do not miss. What requires no decision cannot be decided wrongly. Fourth, choose a simple defensive framework. For most people, I recommend a portfolio that a reasonably intelligent 12-year-old could understand and manage. A diversified stock index fund representing the broad market, a diversified bond fund or treasury securities, an allocation between them that reflects your time horizon and tolerance for volatility, rebalance once per year, contribute regularly, ignore everything else. I understand this sounds too simple. That is precisely the point. Complexity in investing serves the interests of those who sell complexity. It does not serve the interests of the investor. Fifth, set speculation boundaries. I am not naive. Some people will speculate regardless of what I say. If you are one of them, at least speculate consciously and within boundaries. Designate a small percentage of your total assets, perhaps 5%, perhaps 10% as your speculation allocation. This is money you are fully prepared to lose. This is money you will not add to when it disappears. And critically, never confuse this activity with investing. Know exactly which dollars are investments and which are speculation. Do not let the excitement of speculation contaminate the discipline of investing. For those who recognize themselves in what I have described, let me offer a practical 30-day reset. This is not a transformation. It is a beginning. Asterisk, asterisk, week 1, remove the triggers, asterisk, asterisk. The first step is environmental. You must reduce your exposure to the noise that feeds speculation. Uninstall applications that deliver constant market updates. Unsubscribe from newsletters that promise tips and predictions. Mute or unfollow social media accounts that promote financial excitement. This will feel uncomfortable. You will feel uninformed. You will worry that you are missing important developments. You are not. The developments that matter to long-term investors unfold over years, not minutes. The information you are removing is not useful. It is stimulation that creates the illusion of usefulness. Replace this time with something valuable. Read books about investing history. Study the psychology of decision-making, or simply do something unrelated to money. Asterisk, asterisk, week 2. Build the safety base, asterisk, asterisk. This week, focus on your foundation. Complete a thorough audit of your spending. Identify your essential expenses and your discretionary expenses. Be honest with yourself. Begin building or replenishing your cash buffer. Set up automatic transfers to a dedicated account. Even small amounts, consistently contributed, will accumulate. Review your debts, particularly high-interest debts. In most cases, paying off high-interest debt is the best investment available to you. A guaranteed return equal to your interest rate with no risk. Asterisk, asterisk, week 3, automate the system, asterisk, asterisk. This week, build the machinery that will work without your intervention. If your employer offers a retirement plan with matching contributions, ensure you contribute at least enough to receive the full match. This is an immediate return on your investment that no market can provide. Open or review your investment accounts. Select your simple, diversified allocation. Set up automatic contributions that align with your pay schedule. Write down your allocation and your rules. When will you rebalance? What will trigger a change? Put this in writing so that future you, in a moment of panic or euphoria, can refer to it. Asterisk, asterisk, week 4, create your rule book, asterisk, asterisk. This final week is about codifying your approach. Create an investment checklist before you buy anything. What questions must be answered? What criteria must be met? Write these down. Create your personal Mr. Market rule book. Under what circumstances will you ignore market movements? Under what circumstances will you act? Be specific. If prices fall more than 20%, I will. Or if prices rise more than 30% in a single year, I will consider. Review this rule book with someone you trust, not for their approval, but for accountability. Tell someone what you intend to do so that you are more likely to do it. At the end of 30 days, you will not be wealthy. You will not have solved all your financial problems, but you will have begun to replace the silent wealth killer with something more powerful, a process. I have no exciting conclusion to offer you. I have no promise that following these principles will make you rich. I cannot tell you what the market will do tomorrow, or next year, or next decade. What I can tell you is this. The principles I have described have survived every market environment in modern history. They survived the crash of 1929 and the depression that followed. They survived war and inflation and technological revolution. They survived periods when everyone declared them obsolete and periods when everyone rushed back to them in panic. They survive because they are based on mathematics and human nature, both of which are remarkably stable. The silent wealth killer I have described, speculation disguised as investing, will continue to claim victims. It will claim them in 2026. It will claim them in 2036. It will claim them as long as human beings prefer excitement to boredom, certainty to humility, and quick fixes to slow processes. You do not have to be among them. The choice is not between getting rich quickly and remaining poor. The choice is between the appearance of progress and actual progress, between the thrill of action and the satisfaction of results. Most people will choose excitement. They will chase tips and predictions and trends. They will buy what is rising and sell what is falling. They will confuse activity with achievement. A few people will choose differently. They will accept boredom as the price of discipline. They will measure their progress in decades rather than days. They will build their security quietly while others build their stories. The investor who understands the difference between price and value will never be poor for long. The speculator who confuses them will never be rich for long. This is not a formula for spectacular wealth. It is a formula for avoiding spectacular failure. And in the end, avoiding failure is how ordinary people build extraordinary security. The boring road is longer than the exciting road. It offers fewer stories to tell and fewer thrills to experience. But it leads somewhere. The exciting road leads in circles. The process will outlast the noise. It always has. It always will. Your only task is to build the process and trust it, to ignore Mr. Market when he offers nothing sensible, to accept adequate returns in exchange for safety, to protect your capital as if your future depended on it, because it does. This is not the path of excitement. It is the path of freedom, and that is enough